I'm Gary Venner, CEO of IFA Acquisitions, and I'm joined by Alex Canham, who's partner of Herrington Carmichael, where we continue our second informative question and answer series under our YouTube channel to provide top tips and market update when selling an IFA business and an insight into the legal processes when buying or selling an IFA business by two industry experts. The title of this mini video is coming up on screen now.
So Gary, there's a number of ways obviously that businesses can be valued and sort of priced up in this sector. What sort of methodologies have you seen and which ones are the most frequent?
Well, the whole range, to be honest, but I think most of the deals, particularly those deals I would say under, say 100 million of funds under management, tend to get valued on a recurring income basis and a multiple of that. However, if there are going to be a number of staff and advisors that are going to actually follow with the sale, then it is important that an acquirer actually looks at the profit. That's the amount is in terms of the return on investment. How many times am I going to have to pay and get that original investment back? So EBITDA is really important, and EBITDA is really just a sort of a normalized profit. So it's about taking away those one-off costs that may be in the P&L. It may be that the owners of the business are having big pension payments, etc., or maybe higher value salaries. The company car is through there. There might be corporate entertainment, etc. So you'd strip all of that out, and you take out depreciation and interest, etc. So having the core amount of what profit is likely to be earned by the acquirer. We also do project forward sometimes, so we will have what the current EBITDA is, but we will also look at what changes are likely to take place with the acquirer as well. And sometimes you won't pay everything that's going to be done in the future, because hold on a moment, that's the acquirer that's going to be doing that, but it will give that sort of ability to perhaps pay a little more, because it can see that the value, what is the value of this business going to be to me. Both the multiples have increased. We're seeing a lot more buyers in the market with big checkbooks, and they're looking for good businesses. So how do we value a business will depend on different factors within it. And I think to start with, we look at the clients themselves. So there'll be a number of factors there. Average value per household. So the higher the average value per household, especially with consumer duty, and all that goes around that with the actual review process, it's going to command a higher multiple. Than say your business is selling a client back with an average of 100,000. It's going to be much lower value to that acquirer. We would also look to see where's the investment types. Are they platform based? Platform based is good because it's much more transferable. Whereas perhaps if the vendor has got most of its business still on old bonds or even some pre-RDR, you're going to reduce the valuation there again. We look at types of risk as well. The higher the higher risk areas of advice, DB pension transfers, maybe EIS, VCT, they are going to be looked at more carefully. So you may find some acquirers aren't interested in buying a business that has those more complex areas of advice, but others that can actually, they're very familiar with them and they do the due diligence on the file checking and are more than happy with them. They shouldn't actually affect the price as well.
So will you see people sometimes pricing that risk into the valuations then if they perceive it to be a...
Yes and no. I think a lot of people don't actually understand where the value is going to be. They hear of the values that are being offered, and sometimes they're being advertised about what is out there. And so I've got a good loyal client bank, and just feeling that it's going to be based on that. Well, it's not. We're going to look at all of those factors. We're going to look at dates of birth as well. because it's the longevity of a client. A client in their 80s is going to be worth less than a client in their 60s. You just think of the sort of the average ages and life expectancy. We as a broker would not just leave it at that. We would want to know more detail around that age of client. Does that vendor already have the sons and daughters as clients? What else do we know? It may be that you're not wanting to buy a £300,000 investment, but did we know that they lived in a house worth over £1 million, which is unencumbered of mortgage, and it will be available at that point? It may be that there's a business in the background as well. So we need to know a bigger picture. But all of these things help to sort of formulate what that multiple will look like. But definitely multiples, in the last 12 months, 2 years, has grown.
And what sort of ranges are you seeing typically? I mean, the two range areas of valuation we tend to see are recurring revenue and EBITDA. And is there a sort of a range that you tend to see on both of those? Yeah,
the benchmark I would say is 3 to 4. However, there are not many deals that we're seeing less than 3.5 times. That would be for those smaller clients and all those things that I talked about, which drags the multiple down. But we tend to find most of our deals are above 3.5. We're seeing some deals at 5. We've got deals going up as high as 6% of the assets under management as well, which is another valuation metric that may be used. EBITDA multiples will vary on the size of the firm. I think the bigger the hub size, it commands a higher multiple. Let's look at some of the consolidators. The consolidators are hoping to get to sort of 20 times EBITDA, but that is not to be expected for a smaller firm. You're not going to get anywhere close to that, and it may be that you're on 6 to 7.5 times EBITDA. Again, what we do is we analyse, we look at what's there, we look at what could be changed and tweaked, what it could look like post-sale as well as pre-sale. So but the market's good.
And from a lawyer's perspective, when we hear EBITDA, it obviously means a number of things to a number of different people because of the way that you can deal with that through the adjustments. Do you find that for deferred payments and those sort of earn-out periods, EBITDA is often used, or do you see that sort of recurring revenue steps in as a mechanism there because of the simplicity of it?
A mixture, I would say, but you're absolutely right, because the EBITDA can be so easily adjusted, and therefore it often is in the adjustments about a recurring income target or a revenue target, etc. A lot easier to understand, and I think a fairer way.
One of the things that we often see as lawyers as well, having conversations with people, is about their risk. And one of the questions that often comes up is, well, if there is a market event or some other sort of correction, it might be clients taking funds out for various reasons, or something that's causing them to underperform against what they would have liked in a particular year. Do you see that buyers tend to allow them to sort of earn that back if they overperform in subsequent years?
Well, it's an interesting area here, because we often think of it as like Heinz 57 varieties, really, because I think there really are those contracts. And what you have to be careful of is that somebody wants to have all of the best bits for themselves. The deal needs to be fair, and sometimes a deal can be a really, really good deal, but there has to be a limit on what is being offered. We don't see as many contracts that are offering the upside, that if the market outperforms, etc., it will be capped at the original consideration, assumed consideration value. I think from a vendor's point of view, it is about how do I make sure that I can get that and with no downward adjustments, especially if the acquirer doesn't do a good job and my clients leave. So we do see things like guarantees in place there, that if an acquirer says, well, if the client can provide a letter saying the reason they left is because of unprofessionalism or something that they have done, that they would often treat that client is still there, and that can be a really comforting fact for the vendor. Market adjustments, it's equally that some acquirers are will ignore them, and others will say, well, if a certain percentage drops, because let's be fair, if the market does nosedive, that was a genuine situation, and should they be still paying at the higher rate as well? Again, you must see this. There's lots of different ways that we can offer protection. I think it just needs to be a fair contract. It should never be all in one's favour.
No.
Yeah, and that's the best deals that we can see.
No, I'd agree with that. I think from our perspective, it's about a shared endeavour. Doing an acquisition or a disposal and making sure that both parties are mindful of having some benefit to incentivise, but also then not to the point where there is no benefit to the buyer of making the acquisition.
Yeah, I think change as well comes into this. How are my clients going to be affected post-sale? Yeah. We know that the best deals of all are the acquirers that take a slow approach to change. So it's taking time to build the relationship with the advisor. That is so important. And it may well be that an acquirer again doesn't want that 57 different varieties of way of the client investment proposition. It would want to actually centralise a lot of that over time. Again, if as long as there's open architecture, things can stay on existing investment mandates for a period, and that the vendor is actually behind what the CIP is of the acquirer, that it will suit their clients, and they know that it's always, any changes are in the client's best interest, and maybe give it time. The first, say, 9 months of the deal, make sure that there's nothing too much change or whatever. Build the relationship first. If there are going to be changes to the ongoing percentage as well, take your time, explain what the value-added proposition is going to be so that the clients really buy into that. And we do find that most of our deals, literally have no worse than 95%, but most of the time 100% of the deal actually happens because the retention of clients is important.
And that's quite encouraging, isn't it? Because clients always sort of understandably look at the worst case scenario when they're forecasting whether to do a transaction or not. And I think sort of hearing that actually the success and transfer rates when they're integrated into the buyer's book is as high, I think hopefully gives people a bit of comfort. The one thing we certainly see, and I'd echo your views there, is a lot of buyers taking that approach to sort of do the integration at a sensible pace, not trying to force it through. We've seen lots of sort of horror stories in the industry of years gone by where people had tried to move things across too quickly or without sufficient explanation, and regulatory concerns aside, it resulted in clients feeling unhappy when they've been with an advisor in some cases for decades.
And that's really important. When we talk to a vendor and we ask what is the most important, things we've got to make sure that happens in this sale. And clients are right up there. They're one of the top things. And nobody wants to hide away from their clients if they see them in the street or see them on the golf course, and just knowing that it did not go very well. So we just try to align cultures really, and that's what makes for a successful deal. And we've refused to work with some acquirers that we know that are just literally relying on their adjustments process. If the clients aren't happy and they go, well, we don't pay for them. We're not interested in those type of acquirers. We don't like that methodology. We think it's about working together to make sure that retention is there. Subscribe to our YouTube channel and switch on notifications so that you won't miss our next video in the series of top tips and market update when buying or selling an IFA business, and an insight to the legal processes by two industry experts, me, Gary Venner, CEO of one of the UK's largest specialist brokers in IFA Acquisitions, and Alex Canham, partner from Herrington Carmichael, who are leading commercial lawyers specialising in IFA mergers and acquisitions.